All right, I think we'll get started. So my name's Gabriel. I work with the research team at Centaura. I'm glad to have you guys all here to join this webinar, where today we're going to be talking about DeFi Vaults. So it's a really broad term. There's a lot that's going inside of this. I'm going to focus in on just like a couple specific topics within DeFi vaults, just as they are gaining a lot of traction. And we have seen ourselves that there's confusion between what is a vault, what is happening in these vaults, et cetera, et cetera. So let's dive in and kind of start to unpack that a little bit. So from the table of contents, we can see we're going to uh, kind of talk about the history of vaults, what they are, what their base layer is. Then we'll kind of go into some of the more common types of vaults that we see right now, some of the risks that are involved, and then the conclusions of everything. Of course, as always, some updates from Centaurus side. We have launched a couple new products. So first one is FBTC Vaults. Function Bitcoin is a wrapper style Bitcoin that was initially coming from Mantle, but it is accessible on multiple blockchains now. And we have launched a vault, a private vault that allows for users to utilize different strategies on Euler and different Aave instances. So this one is in partnership with some different centralized exchange earn programs. Really excited to see how this moves forward and being able to help users who are not so familiar with DeFi access DeFi through these earn programs by deploying into the strategies that we run. On top of it, we have some new strategies that we have started running on Aave Horizon. So if anyone's unfamiliar with Horizon, it is the real world asset instance on Aave. So has a couple different assets that are different real world style assets that are publicly traded. And these are yield bearing, and there are some strategies that can be used implementing those by borrowing other stable coins. And this is all live, and we've been running these strategies for some time now, and we're seeing a lot of good growth and demand, which is always beneficial to know that this real world assets trend or category in the space is growing, meaning that more and more capital is coming on chain. And then finally, we have a whole bunch of different risk radar updates. So we have two new dashboards, one for a AMM protocol on Flow blockchain, and then another one for a lending protocol on Say blockchain, so KittySwap and Yay Finance. And then we also have a whole bunch of new indicators that we have added to our Aave dashboard. Specifically, one is our correlated leverage borrows and collateral indicators. So these are really helpful for tracking how much of an asset is being borrowed by correlated assets, or the other way around, how much of an asset is being used as collateral to borrow a correlated asset. So these can be really helpful to understand what sort of like concentrated exposure you have to one asset that is most likely doing one specific type of trade, which is leverage looping. This is something that really can become important with how we've seen the validator exit queue go up very high and on how many days it takes to exit. So in an example with ETH, if people are doing this trade and you can see how much of the ETH being borrowed is to utilize this leverage loop strategy, you can start to understand what sort of duration risks that are that Aave's markets are exposed to. So really helpful. Some more information for being able to manage complex trades. So let's dive into it. What are vaults? It's a pretty broad term, and there's a lot of definitions around it. But at its core, for DeFi, it is a smart contract where you can deposit. Uh, Multiple users can all pool their assets into the vault, and the vault is going to be automating yield generation for them. That is kind of the definition that I think is most common now, where anybody can deposit, let's say, USDC into this vault, and then the vault has some sort of programmatic decisions on um, how to deploy those assets into some sort of strategies that are going to earn yield. The big thing that is quite helpful and has one of the reasons why vaults took off several years ago is that they have this auto compounding design. So you don't have to claim your assets and uh, then convert them back, claim your yield or incentives that you've earned, claim them back into your underlying token and redeposit. It does all of that for you. And this was really helpful in the beginning with a lot of like avoiding high gas fees on Ethereum, back in the 2021 era when we first saw these vaults really take off. And then also with these vaults, to varying degrees, they're non-custodial, meaning that you can just withdraw from them anytime. We'll get a little bit more into that later on, but yeah, so usually you're able to just withdraw your assets when you want without having to have or having minimal unstaking periods or delays, with no one else controlling if you can or can't withdraw. So to go into the base layer of what most of the vaults we see are today on Ethereum mainnet, they are ERC 4626 tokenized vaults. So how these vaults work is that it you're able to deposit one asset into the vault, then you get a fungible share token of that vault, which represents how much of your deposit you have in the vault relative to all the global deposits in that vault. That's what's called the receipt token, and it represents your share of the vault. And so this is what's being used to track not only your initial deposit, but how much of the yield is allocated to you, and you have the right to withdraw when you decide to exit the vault. So this diagram, I think, is a fairly straightforward diagram of how it works. Is that you have the users depositing into the vault. These deposits get deployed into some different types of strategies by varying degrees of percentage of all of the tokens deposited here. One thing that we don't see in this diagram is that once you've made the deposit, you would be getting that receipt token back. So that usually shows up in your wallet after you've made that deposit, and you can see it there. And the difference between the exchange rate or the receipt token and the first asset that's been deposited is some sort of exchange rate defined by the vault. So you're always able to get back your initial deposit plus any sort of yields that you have accrued since. So let's take a look at what vaults looked like kind of right when they first launched, when ERC 4626 standardization came into effect, and what they look like now. I think probably the most well-known one is Yearn Finance from the early days. So this initially was a single strategy, really looking to farm the incentives that were happening in back in 2021, et cetera. There was 1,000% APRs on certain tokens, and so Yearn was able to capitalize on this by creating these vaults where people could all deploy their assets there. They would farm the tokens that were being generated at these ridiculous APYs, and auto compound those for the users, because as people know from back in that day, it was you would be sometimes paying like $300 or $500 worth of ETH as gas for a single transaction. So the really big benefit from this was that users were able to avoid paying this gas all the time, and the scale of the vault was able to make the economies of scale essentially, made it much easier for the vault to do this harvesting rather than each individual doing it themselves. um, Yearn V2 came out not that long after, which uh, created the vault structure that I think we see a lot today, which is allowing for multiple strategies per vault. So rather just having it be one strategy on the vault, you would have maybe multiple pools on some sort of uh, AMM that you were depositing into and farming all of those pools at once. And this allowed for, as we would call it the set it and forget it rather than this manual process, which while it seems like maybe it isn't something that would be as important for people that are in DeFi, actually this ability to deploy your assets and then have a lot of this work done for you, we have seen be quite popular because there is a lot of complexity, and the complexity just grows as new blockchains, new protocols join the ecosystem. So being able to kind of delegate a lot of this work to somebody else has a very beneficial impact for a lot of retail users and also institutions. Yeah, so just a quick item. Feel free to ask questions in the chat or in the Q&A section. I'll probably get back to most of them at the end of the webinar. So moving on to modern vaults, I have two of them that with the definitions that I have made. I think that these can be kind of pretty broad definitions that most people would accept. But one caveat to all of this that I think is important is that the nomenclature around vaults, specifically in DeFi, is a complete mess. So it's something that you always want to take into consideration when you're trying to deposit somewhere, to make sure you understand what you're depositing into, because one product on one protocol might have the same name as a completely different product on another protocol. So this is always something to DYOR on to make sure that you aren't making any mistakes on what you're trying to deposit into. But with that said, earn vaults, these are usually quite simple, passive yield on one asset. I think the most well-known version of this is Morpho, since they kind of pioneered this design, which is you have what they're called metamorpho vaults, that you deposit one asset, let's say USDC, into that vault. That vault distributes all of the USDC that has been deposited into individual markets on Morpho. And so for a user who's just planning to lend and they just want to get yield on their USDC, this is a very easy way for them to deposit into this vault, and it's going to be getting higher rates usually than something like Aave, because there is someone called a curator that's making sure to delegate the allocations of all of the USDC in that vault into these different markets to get the highest risk reward return for the assets that have been deposited. We'll dive into some more details on that one coming up, but the other vault that is also been quite popular and maybe has less clarity on like the nomenclature around it is what I'm calling multi-strategy vaults. So think of Veda, think of so the EtherFi liquid vaults, some of the Berachain vaults that were initially deployed, Lombard vaults. So These are vaults where you deposit an asset into it, and the strategies in the vaults aren't tied to that one protocol as the earn vaults usually are, but they can be deployed into multiple protocols and strategies all at once. So the big difference here is that they are chain and protocol and strategy are agnostic, where the earn vaults usually are a bit more structured into what sort of strategies and deployment use cases they go into. So they're all built on top of this ERC 4626 design structure, but they vary greatly in the scope of what the strategies are, the complexity, and the risk. So as an example that I was showing before is with Morpho, you have kind of this example here where you have two suppliers. They want to deposit into two different vaults. So think of ETH Vault 1 as maybe being the Steakhouse ETH Vault on mainnet, and then ETH Vault 2 could be the Gauntlet Vault on mainnet. So they're both accepting the same asset. But once you've deposited that asset into the Earn Vault, it's getting distributed to different submarkets within Morpho. And so in this example, you have these final markets here. Let's call them, where you have a pairing of two assets. So ETH, which is the asset being lent out, and then STETH, CBETH, or SDAI, which are the collateral assets that are being used as collateral to borrow the underlying ETH. And so, again, how this setup is that these curators, which in this example are Steakhouse and Gauntlet, they manage their vault by distributing the ETH into different markets to get the best risk return reward as they see fit. And the users can look at these different vaults and decide, they think that the collateral on this one is too risky. They like the returns on this one. And so they choose which vault to deposit into. And then they don't have to do anything else. When they decide that they want their ETH back, they just have to withdraw. So quite easy. Specifically that these are, especially on Morpho, these are very non-custodial vaults. You can withdraw whenever you want if the liquidity is there. And Morpho makes it very easy for people who are supplying to the markets to withdraw when they want. Again, so here are some examples. Morpho Euler Earn, which is a newer product that is built to do the same thing as Metamorpho into their entire vault system that they have. So a little bit more complex, but kind of accomplishing the same thing. And then this isn't just Ethereum mainnet specific. These Earn vaults happen other places. Specifically, Camino Earn has seen a lot of success. It's not built on the ERC 4626 design because that's obviously Ethereum virtual machine-based logic. It's Solidity code. Theirs is a bit different, but it's practically implementing the same thing. So after Earn vaults, we have multi-strategy vaults. As we said earlier, it is really focused on one single asset being diversified across multiple strategies all at once. They're protocol and strategy agnostic. So a Veda vault, for example, could just be deposit your USDC here, and then we run strategies on all sorts of different protocols and blockchains. What we tend to see is that there are kind of like, let's call them theme vaults. So EtherFi has their own vault that is deploying into strategies. Lombard has their own vault. Berachain, blockchains. There was the Veda vault for Plasma that really people heard a lot about because they got so much pre-deposits there. And so these assets all get aggregated there, and then they get deployed into maybe some sort of specific set of strategies within the ecosystem to help benefit the ecosystem that the theme is based on. So within this, instead of curators, there are strategists or like a controller logic within the vault. that rebalances all of the different strategies based on yield, risk, and liquidity. So as people are wanting to deposit or withdraw, it's going to be rebalancing all of these strategies to make sure that it can satisfy all the conditions that have occurred. So for example, there's a large amount of withdrawals, you might have to start unwinding one of the strategies to make sure that you can satisfy all of those withdrawals. And so this design definitely captures a broader yield and usually can have higher yields compared to an earn vault because it has more flexibility to choose new strategies as they come online, where the earn vaults are usually contained into the protocol that they're built on. And they reduce concentration risk. There's definitely other risks that do increase, but instead of having everything just focused on one protocol, it has multiple protocols that it's in. So, if there was some sort of exploit, your eggs aren't all in one basket. And then again, some of these, I think the most well-known one is Veda and its boring vaults, but you do have other examples like Concrete, Upshift, and then IPOR is kind of the more unique one out of the other three because it is a protocol that has these vaults. It has somewhat of a similar design to what you might see on the other three vaults, but it's all built into its own protocol that it runs, where Veda, Concrete, and Upshift often get deployed into, they get launched on another protocol to help generate some sort of liquidity and attraction for that specific protocol. IPOR has all of its vaults housed in its own protocol, where you can access these different vaults from their front end. So the thing with these multi-strategy vaults is that you can start building some interesting products on top of them. So not only can they deploy into multiple strategies, they can also, potentially do some off-chain stuff as well. And so you can start to see things like yield-backed stablecoins, where maybe they're running some sort of basis trade strategy that's similar to Athena as part of the subset of strategies that they have. And then you get what these protocols often call a synthetic dollar that starts at 1, but starts to accrue in value as yields come in. But to specifically say they aren't pegged to the dollar. So there is a chance that if there is some sort of issue within their strategies, that the yields that you have seen accrue can be lost. And so it can be worth less than $1 as a full disclaimer. But we're seeing a lot of these different yield-backed DeFi strategy stablecoins launch, and they all have a very similar multi-strategy vault structure to them. And then, as I had talked about before, themed vaults or sometimes index vaults, which are less popular. The themed vaults are usually the one that we've seen a lot of: the Berachain pre-deposit vault, Plasma pre-deposit vault, Liquid, etc., which are the ones that we usually see. And they're often the underlying infrastructure is provided by one of these three protocols in most cases: the Veda, Concrete, and Upshift. So what are the differences? I think it's pretty easy to summarize. So scope, earn vaults are usually with a single strategy. Now there are some updates from like Morpho and even Euler that could start to broaden that out, and possibly Aave as well. But as of right now, that's the kind of the design, where multi-strategy vaults, it's in the name, they run multiple strategies. Architecture is usually one vault, one protocol. I mean, there can be multiple vaults within one protocol, but everything is contained in the protocol that it is based on. Where for the multi-strategy vaults, as they are agnostic, they can be deployed and managed across n amount of blockchains and protocols, as long as everything can come back when people want to withdraw from the main entry point that they deposited into. The UX, earn vaults are definitely much easier. It's very streamlined. You deposit, you see the yields. They're kind of often organic yields, so it's very easy for them to account for. On the multi-strategy vaults, it's a lot of coordination. There's often cooldowns, position unwinds. There's a little more friction definitely as of right now on these vaults because first the accounting on all of the yields from these different venues is quite complex, and if a large whale wants to withdraw from the vault, it can have a big impact on the strategies and positions that are in this vault. Sometimes there's a certain amount of duration that is locked up into the vault. And so unwinding these can sometimes take time, where that's where you see some cooldowns that end up happening, where it maybe takes a couple days. Often it's built into the whole design, but it can take a couple days to make sure that everything is accounted for correctly, and then you're able to actually withdraw your assets. The yields earn vaults are usually quite steady, outperforming just depositing into a single market, but not as high as multi-strategies, which can be much higher, but definitely more variable. There's a lot of often points and airdrops that are involved in some of these strategies, so these can have a quite variable effect on what sort of returns you get once those rewards are realized. And then for control and custody, earn vaults are usually very non-custodial. It's exactly the same as depositing into Aave or any other lending protocol. You are able to withdraw that whenever you want instantly. There's not an issue there. Where on multi-strategy vaults, as I said, there can be some time locks, even though it is non-custodial. There's built-in time locks just to make sure that everything runs smoothly. And then on the curator inputs, the curators are on earn vaults are usually very well defined what sort of parameters they have, and it's usually constricted a little bit. Where curators on multi-strategy vaults, it's essentially what they decide. So you're putting higher trust assumptions onto these multi-strategy vaults than sometimes you would on an earn vault. Sometimes it can be the other way around, but often the case that you're relying on team and operational execution to be at a much higher standard on multi-strategy vaults than the earn vaults. What sort of risks can you see? Classic ones, smart contract risks. These always exist. When you think about it, for the earn vaults, it's usually just one layer. Maybe sometimes you could call it two, but it's just what's in the protocol. On the multi-strategy vaults, these layers can be very complicated because you might have multiple different protocols that the vault is deploying into, and maybe these protocols deploy into some other sort of strategies on different protocols. So this one can become very complex. So it's always important to try and understand and weed out how many smart contract layers there are, because this starts to increase the potential risk vectors that you might have. This ties in with the underlying protocol risk. And then the operational risk, while I did mention it in the previous slide for multi-strategy vaults, there have been some instances on earn vaults where the curators have maybe allocated a heavy amount of what assets were in their vault into pool pairings or market pairings with risky collaterals that have ended up in precarious instances, or even the curators have lost some assets from there. So while there is more restrictions on what the parameters are, curators can manage on some of these earn vaults. It's still, they need to allocate into different markets and make adjustments if they see risky situations happen. And then regulatory censorship. I mean, this kind of hits everywhere, but this probably is something that is more on multi-strategy vaults, that you need to make sure that one protocol that you're managing in doesn't have some sort of issues that shuts it down while your assets are in there. So these are always things to keep in mind. And then strategy specific risks. I think most of these are related to the multi-strategy vaults, but impermanent loss, because you can be deploying into AMMs with volatile pairings, liquidity withdrawals, these cooldowns and fees for entering and exiting, and duration risk that I mentioned, market and price risk, of course. Leverage and liquidations. It kind of connects to the duration risk that I had mentioned, but essentially, a lot of these multi-strategy vaults do run some sort of looping strategy where they're either looping Athena-based, as a good example for stablecoins, Athena-based assets with idle stablecoins like USDC or USDT, or they're doing it with ETH. And so the questions are, how easily can whatever size position of this strategy be unwound if it needs to be? And if it can't be unwound immediately, how long would it take for it to unwind? And would it be at risk of liquidation during that time? So these are some of the questions that need to be answered. And then I think most recently we've seen this on the October 10th flash crash is imbalanced delta strategies, where, as I said, a lot of these multi-strategy vaults are running basis trades on different venues. And with this flash crash that happened and the auto deleveraging being put into effect on some of these different exchanges, it left certain people in a position where their delta neutral hedging, the two legs that they use for the hedging of this delta neutral strategy, were not in balance, and this can expose them to the depositors in a risk where there's a liquidation that they aren't able to, the protocol isn't able to resolve, and that could end up being a loss on the larger vault itself. How to monitor risks. I think checking for audits, always important. Reviewing the collateral and strategy exposures of these different vaults. So making sure you yourself understand at least the gist of what some of these collaterals are that they're deploying into, or how much concentration they have. If it's a strategy that is 80% running this leveraged loop trade, maybe this is something that makes you concerned and you don't want to deploy there. You'd rather deploy into an earn vault that can't do this sort of looping trade. Monitoring parameter adjustments from the curators or strategists. I think this is quite important. On the example I have here is from Centaura's Euler Risk Radar, where we track for each of the different vaults governance updates that have been made by the risk curator. So this is an example from our Centaura RLUSD vault that we have on Euler and Ethereum mainnet, showing all of the adjustments that have happened, borrow cap, supply cap changes, interest rate model. So tracking these can help you get an idea of how well the curator is managing the risks that they perceive in the marketplace, to at least know that they're maybe actively doing it, or you can also check and see if they've become quite aggressive over time, just to make sure that they have the highest yields in the marketplace. And then real-time transparency on any of these, which us at Centaura have indicators for Euler and for Morpho. So these are two of the bigger earn curation protocols. I'm sure that my colleague can share our risk radar in the chat, where you can explore Euler V2 dashboard and the Morpho dashboard that we have. In conclusion, vaults are becoming almost commoditized and becoming this vault as a service, where it's very easy to spin up a vault and use it to provide financial services for end users. Earn vaults are much easier, and they are probably the best suit for someone who wants to reduce any sort of risk exposure, but still, you want to make sure that you see that the curators are adjusting properly over time. Multi-strategy, while they're quite helpful in attracting a lot of yields just based on their scale, they can attract yields that are harder for retail users to manage and deploy into. Um, these are things that you definitely you want to make sure that the strategies are transparent. You can easily see them, and you want to make sure that uh, the team, the audits, the risk limits, concentrations on strategy and collateral, and how withdrawals can happen are all in line with what your perception of the product is. And then again, nomenclature is not standardized at all, which is really difficult even for people that are working all the time in this field. So always try and double check and make sure you understand exactly what the product is you're looking at. Our next webinar is going to be AI powered research. I'm covering alpha and DeFi markets. This is something that we've been doing a lot of work on. I think it was just shared in the chat to sign up for that. With a lot of these LLMs really making huge advancements in the last year. It's something that we work on and use quite a lot. How we can harness this to discover new opportunities, discover new things, and become more efficient in our space, being able to react faster to different market scenarios. Thank you. Now questions.